P/E ratio will humble traders faster than any crash. Because price alone is a drama queen. If the market price of a company is 80 and earnings per share is 2, then its P/E is 40. What that means is, it means how much money do we have to invest in that company to make 1 rupee. You want to make 1 rupee by giving 10 rupees or by giving 40 rupees? If you are curious and want to know more, please like, subscribe and comment. If your yearly sales number aren't rising, then your comfort zone is killing your business quietly. It is a fundamental indicator of financial health, growth trajectory and market position of a company. Consistent sales growth proves your product or service is in demand, and your strategy is unstoppable. Profit of a company can be easily shown as high or low on papers while preparing the balance sheet. But the sale of a company is more important than its profit. Growth, even during economic downturns, signal a strong and resilient business model, making it investor-friendly. If you want to know more fundamental facts, please like, subscribe and comment. Ever wondered how smart your money really is? Miss this, and you'll chase returns forever. Return on equity shows how well a company turns your money into profit. Higher return on equity is your money working hard. Lower return on equity is your money chilling. Imagine you invest 100 rupees in 2 businesses. Business A invested that 100 rupees and made 10 rupees, or Business B that invested 50 rupees and made 10 rupees. Which is more efficient? It tells you how hard your money is working inside a company. If you want to know more fundamental facts, please like, subscribe and comment.
The 3 most important words in investing according to Warren Buffett are margin of safety. It is the difference between a stock's intrinsic value and its current market price. For example, if a stock's intrinsic value is 100 rupees and it is currently trading at 50 rupees, then there is a 50% margin of safety on the potential purchase. It means buying a stock at a price much lower than its real value, so even if you're slightly wrong, your downside is protected. All there is to investing is picking good stocks at good times, and staying with them as long as they remain good companies. If you want to know more fundamental facts, please like, subscribe and comment. Why high debt companies look attractive until they crash. Many businesses look cheap on P ratio, but are expensive because of it. Debt to equity ratio tells you how much a company depends on debt to run its business. High leverage equals higher risk. In good times, profits look great. In bad times, debt kills cash flow. It shows whether a company is growing with strength or surviving on borrowed time and money. Lower debt gives margin of safety and survival power during downturns. It is better not to invest in companies with a debt-to-equity ratio of more than 1. If you want to know more fundamental facts, please like, subscribe and comment.
2 companies show 25% returns, but one of them is just a house of cards. Both return on capital employed and return on equity show how efficiently a company generates profit. But understanding the gap between them is often the real investment secret. Return on equity is profit against only the shareholders' money. For every 100 rupees the owners put in, how much did they make back? Return on capital employed is profit against the entire capital used, equity plus debt. For 100 rupees the company used, including loans, how much did it actually earn? If a company has massive debt, its equity becomes very small. This makes the return on equity look astronomically high, even if the business is struggling. A safe, high-quality business usually has both ratios, above 15% and moving in tandem. Subscribe for smart investing concepts most people ignore. A low PE doesn't mean a stock is cheap if the company isn't growing. That's why pro traders use the PEG ratio. PE shows price, not growth. That's why many people wrongly reject good stocks. PEG takes the PE ratio and divides it by the company's earnings growth rate. PEG around 1, price and growth are balanced. Below 1, you're paying less for higher growth. Above 1, you may be paying too much for it. It helps you find undervalued gems in any market at a fair price. The sweet spot of investing. Subscribe for more hidden gems.